Welcome to the first ever video of the channel, ladies and gentlemen. My name's Jimmy, and if you like investing and making money, then stick around because I'm going to be going over the 5 most common mistakes new traders make that could do serious damage to your finances. Right, apparently now I'm supposed to give you some spiel about smashing the like button and subscribing to the channel. Right, you guys go and do that and let's get on with it. Look, unless you've been living under a rock recently, you would have seen now a social media group called the Wall Street Bets have been making a ton of money going head to head against the big powerful hedge funds. Now this in turn has caused an increased interest in trading securities. This has increased clients of these new trading apps by 200%. Now the majority of these trades have been made on these new fintech startups that have ditched charging a fee per trade to a more subscription based system, a bit like Amazon or Netflix. These companies make their money with interest, a bit like a bank that lends out money with credit in your account. And there is also something called payments for order flow, which is the practice of receiving commissions for directing orders to different market makers for execution, which they refer to as rebates. Problem is, some of these new traders have no experience and have no clue how the markets really work. See, this is generally how the scenario goes. They've watched all the hype in the media, so they download a trading app. They find a share that they like, generally one that's always in the media or hyped up on some social media site. Now the adrenaline's pumping as they press that bid buy button. And now they're on their way to making $1 million, right? But the only thing is, the share price is going down. Wait a minute, that's not supposed to happen, right? Everybody's been talking about this share. So they decide to hold and buy some more. Problem is, the price keeps falling, and now they are in so deep they couldn't possibly sell at that price, until eventually they have no choice, and they never want to go near the stock market again. Now this is the worst case scenario, but it's not uncommon. Being able to separate the emotion from the trade and look at it in a logical manner. But when there's people's money on the line, this is difficult. People start to panic, which then leads to bad decisions, keeping hold of losses and selling winning trades prematurely. You see, 80% of traders lose money. You'll know this because on every trading platform there'll be a warning stating the percentage of clients that do so. So if 80% lose money, where does that money go? Does it simply transfer over to the 20% and make a profit? Well, not exactly, no. You see, the stock market is based on supply and demand. See, look, you sell a stock at a loss. The person who buys it doesn't necessarily make a profit. He has to wait for the stock price to rise. Still, you're well out of pocket. So look, instead of throwing all that time and money away, I want to help you make better decisions in the future. So let's start with the first one, day trading. Now day trading is the act of buying and selling a security on the very same day or the shortly after. But don't believe all these YouTube videos promise you thousands of dollars a day sitting at your screen trading shares. It sounds like a great way to make a living, right? But unless you're incredibly disciplined, as cool as a cucumber, and have stacks of readies at the ready, then you are going to lose a lot of money and fast. This can also be a really stressful way to make a living, watching the screen all day waiting for the opportunity to pounce on a trade. Pennies count in this sport, and you often need a lot of equipment to make it work. Right guys, number 2, forex trading. Now in all my years of trading, I have never personally met a successful forex trader. I'm not saying they don't exist, I'm just saying they are very far and few between. This to me is just gambling. Yet this is advertised all over the internet as some kind of get rich quick scheme, with so-called successful traders standing next to expensive cars promising to make you millions of dollars. Traders can find themselves in all sorts of trouble being offered high leverage amounts of money to small amounts of capital. There was a story in 2015 of a teacher when in the middle of teaching a class received a message from his forex trading broker saying that he owed the company $300,000. So all it takes is one big trade to go wrong and you're in serious debt to the company. Let's move on to number 3, averaging down. Now, averaging down is a strategy of adding additional funds to an asset that has dropped in price, hoping that the price will recover, regaining your original funds with the chance of making a bigger profit. So look, let's assume you buy 100 shares of Apple at $10 a share, equaling to $1,000, right? And then the share price drops to $8. Now your shares are worth $800. So you decide to buy another 100 shares costing $800, hoping that the price will rise back to $9. And if the price rises back to $10, you would have made a $200 profit. Now the problem is, this strategy might work in a company that's got good long-term prospects. But a considerable drop in price is normally for a reason. And unless you've done your homework, the price could just keep falling, magnifying your losses. Right, number 4, following the herd. Buying an asset just because everybody else is not a good investment strategy. But if everyone else is buying it, psychologically, this confirms to us that we're making the right decision, even though we can't find a fundamental reason for doing so. In 2017, Bitcoin's price rose 1,900% to $19,000. This started to appear heavily on mainstream news and all over social media. That is when FOMO and greed set in, which then pushed the price even higher. The problem is, most of those people were buying here at the top of the chart. And when it ran out of buyers, it was only left with sellers. And when this happens, the smart money that got in early exited the trade, leaving the herd with huge losses as the bubble finally burst and subsequently went on to lose 80% of its value. Now, last but not least, number 5, falling in love with your shares. Investing in an asset is for one reason only, and that is to make money. You do not need to hold them until death until part. They are not for life. Yet you will hear time and time again how traders will put all their eggs in one basket, buying a share that they love even though the price keeps falling. I recently heard a story of someone who put all their life savings into a stock that went all the way from $10 down to 2 cents, and they lost everything. Right guys, I hope these points will help you with any decisions you might make in the future. And again, hit that like button, subscribe to the channel, and I will see you in the next one.